Today, we're going to talk about the first of many of the three basic different kinds of social benefits that you could actually get from the government of Canada. Basically, the first one where we usually start, of course, is old age security. Most of you will probably know it as OAS. And in order to be eligible for OAS, it really is a resident for 10 or more years, basically, we look at. When we look at old age security, we're not talking about if you were working. So here, it's just basically a residency. So even if you never worked a day outside of your own home, you're a stay-at-home, home care, homeowner, spouse, whatever, taking care of your children, whatever the case may be. So you're not working outside the house at all, essentially, okay, then you're still going to qualify for this. So this is very much driven by residency, not by occupation or income or anything. Everybody basically gets it when they're age 65. Okay, so if you're going to stay in Canada and receive your benefit, the benefit will start at age 65. Or it could start later. Today, of course, you can delay it all the way up to age 70. So obviously for every year that you delay it, you're going to get more. So the idea here is the government of Canada is saying is if you don't need the money at age 65, you don't have to take it. So the longer you delay it or defer the income, the more you're going to have at the other end. So you could defer it actually all the way up to age 70. So you could start later rather than sooner. But you cannot start any sooner. So 65 is the magic the magic age and everything. Okay? So if you've been living in Canada for 10 or more years, and you are now reached age 65, let's say, you will start getting some kind of a pension. Obviously, you're not going to get the full pension because in order to get the full pension, you need to have 40 years. So basically, the 40 years is gives you the maximum amount of money that you could get, which I believe today is just about $7,000 a year would be your maximum. But if you only reside in Canada for less than 10 years, you get nothing. Okay, so between 10 and 40, you would get a proportional amount. So if you only did, let's say, 20 years, then you get half of the $7,000. So basically, that's how they juggle these things around. Okay. Now, if you decide that you would like to be able to still receive your OAS because you are 65, but you don't want to reside in Canada anymore, once you lose your residency, of course, you lose the OAS because, like I said earlier, this is residency driven. So if you're no longer a resident, theoretically, then that income will stop. And usually you will lose your residency if you've been away, you've been out of the country for 183 days, in other words, 6 months or more. You no longer technically are a resident of Canada, so therefore the OAS will stop. That doesn't mean that it stops forever. In other words, when you come back and you reestablish residency by staying in Canada for 6 months or more, once again, the OAS will be reinstated. So you don't lose it forever. You may only lose it for a period of time where you've lost your residency for 2 years, whatever, and you come back, and then you can simply reapply for the OAS. Okay. However, if you, in fact, have been in Canada for 20 years, okay, so 20 years since age 18, then you could, in fact, take a pension outside of Canada. In other words, after 20 years of living in Canada, and now you decide that you are 65, but you have been living here for 20 years, and you decide you are going to leave the country or whatever, they will continue to pay the OAS. So the real kicker here is that if you're in Canada, 10-year residency is the absolute minimum, and you continue on getting it. But if you ever lose the residency, then that income will stop. If you are, in fact, 20 years in Canada, then you may leave and you won't lose your residency, so that check will arrive every single month, just like before. So those are the two criteria that are very, very important. And to get the full benefit, you have to contribute for the entire 40 years, basically. The benefits, of course, are indexed, and they're indexed on a quarterly basis. So this does follow inflation. So every quarter they get adjusted accordingly. So normally what happens is you're going to get a letter every year saying, here's how much money you're going to get this year, but it is only going to be for this quarter. Then it'll be adjusted accordingly for the next quarter. So benefits are in fact indexed. Okay? In terms of taxation, they are fully taxed. In other words, this is full taxation, so it is considered income. You will have to put that on your T1 basically as income, and therefore you will have to pay tax on that. Most important thing to remember about OAS is this here, is that it is subject to clawback. And that clawback basically is a means test. So, for example, in 2016, I believe it was around $74,000. So up to $74,000, there'll be no clawback. So if all you did is you earned $74,000 of your own individual income, so it's not family income, just strictly your own individual income, up to $74,000 using 2016 numbers, okay, there'll be no clawbacks. You get the full benefit of roughly around $7,000, okay. However, for every dollar that you earn over that $74,000, you will lose 15%. Okay, so for every dollar above the threshold in 2016 number was, let's say, roughly around 74,000. For every dollar above that, you will in fact lose 15% of that. So if you extrapolate that, you'll see that roughly about $118,000 earner will lose the entire OAS. Okay, so it is subject to a clawback provision. So part of the tax planning that you always try to do is try to stay within that threshold so that you don't lose the OAS. But just be aware that it is subject to clawback, and it will be subject to 15% clawback for every dollar above that threshold. Okay. The next thing is that stems from OAS is what we call GIS. Okay, GIS, Guaranteed Income Supplement. Okay, so GIS is for that lower income situation. Okay, so this is an individual, of course, who are in the lower tax bracket. You cannot get GIS unless you get OAS. So GIS is driven by OAS, so you can't skip it, so to speak. This is where you start, and then if they discover that you're making, let's say, less than $30,000 or something, usually that's the threshold between 15 to 30,000. There will be additional financial support, and that additional financial support is what they call a GIS, Guaranteed Income Supplement. Okay, that is not taxed. Okay, it will not be taxed. It's just simply income, but it's not taxable income. Okay, you always have to be living in Canada. So if you decide to take this option here after 20 years, you're gone. Basically, that's your privilege. You won't lose your OAS, but you will lose your GIS. So GIS is while you're living in Canada, you will continue to get that amount. The amount basically that we're talking about here depends very much on your marital status. So here we do look at family income. So we're going to look at the whole picture. And so usually what happens between $30,000 to $40,000 at family income, you're not going to get GIS. Okay, so in other words, you don't need us anymore. But if you're single and you're you're making $25,000 or whatever it is, then yes, you're going to get your GIS. So the amount really very much will depend on your marital status, you're married or single, whatever, and how much of the family income, total family income comes in. So it is a means test basically. It is also subject to clawback. Okay, not the 15% that we're talking about here. Generally, it's 50. It's basically for every dollar that you make above the threshold, which is roughly about $25,000. You're going to lose $2 of benefit and everything else. So once again, it is a means test. So for our purposes, all you remember is clawback. That is subject to clawback. The last one is the allowance. Once again, I draw your attention to the fact that somebody must be receiving OAS in order to get to allowance. So if your spouse is 65 or older, so if you're 65 or over, let's say, and you have to have a spouse that's 60 years old, and once again, you're in the lowest sort of totem pole based on the lowest tax position and everything else, okay, that spouse of yours who's 60 to 64 could in fact apply for an allowance, and that allowance will be non-taxable. Once again, you have to be living in Canada. It is not subject to a clawback. It's not subject to any kind of taxation, anything along that line. All we're saying is that you, as the principal earner, let's say, are 65 and over, and you're receiving these benefits here, but you happen to be, again, the lower income bracket, and you have a younger spouse, 60 to 64, you can apply for the allowance. So that'll be, again, supplemental financial help and everything else. And you notice it's 6 to 64 because at 65, of course, that spouse of yours will get the old age security anyways, okay? So therefore it stops. So this is very limited coverage for a very specific period of time, a very specific tax bracket and everything. And beyond that, you won't have to worry about taxation, clawbacks, or anything along that line. So these are your three main sort of social benefits, you might say, that pretty well cover, I'm going to say probably a good 90-95% of Canadians will automatically be entitled to get all these things here. So you should be aware that these benefits are available to the public and everything else, okay? And we'll see you next time.